Hello everybody, welcome back to another video from Dividend Snapshots. This time we're going to look at Verizon, but before we do, I just want to give a huge shout out to everybody who subscribed so far. We have now reached 50 subscribers, and that is just amazing that 50 people are willing to follow these cards and all these analysis. So I think that's really cool. So thank you each and every one of you, and let's jump right into the snapshot. So as mentioned, we are going to take a look at Verizon. And Verizon is a company that offers communication, technology information, entertainment products and services to consumers, businesses, and governmental entities worldwide. Over the last year, they are down 10%, almost 11%, and they were quite stable until April. And then they took a pretty deep dive, hitting almost a record low for the year of 45, but they have since come back a little bit. So they are just over the 50 mark at the time of recording. So they have a market cap of $215.4 billion, and the share price at the time of recording is 50.81, and that is the 6th of June 2022. If we take a look at some of the indicators that we look at, it has a forward PE ratio of 9.40, and that is compared to a average 5-year PE ratio of 11.87. So that could indicate a bit undervalue here. They do have revenue growth over the last 5 years, so that is a check. The profit margin is unfortunately not above 10%. It's only at 6%, but for a company like Verizon, I think that's still okay in that regard. And net income growth is also a check, but it's over the last 4 years only, not over the last 5 years, but they are growing the net income. But they aren't doing any share buybacks. They have actually increased the number of shares over the last 5 years with 2.8%. The dividend yield is 5.04. And the payout ratio is a pretty healthy 46.83%, so that's a check. The dividend growth rate is quite slow. It's only 2.09, so that's a negative in this one. Dividend growth history on the other side is 18 consecutive years, so that is pretty good. And the dividend per share is thus increasing. Over the last 5 years, they also increased their free cash flow growth, but they do have quite a lot of debt, so the long-term liabilities are not coverable by 5 years of free cash flow. It would actually take them 13.8 years to pay it all back. But the price to the free cash flow is below that 15 to 20 range, and for a company with this growth, I would definitely have it below 15, so it's at 12.6, so it's a pretty good one here, and it sits at a pretty good value, fair value versus the free cash flow. A verdict here is that it has 10 checks out of 14, and I have some comments that based on the free cash flow, I think it's around 15 to 20% undervalued. They do have a lot of debt with. In this kind of business, it's a very, very capital intensive line of work they're in. I think there could be make arguments for both of it being a recession proof company and also a recession risky company, because it's a phone company. It's a lot of people consider it an essential service. But again, if it comes to a recession, will there be a price war which will hurt both Verizon, T-Mobile, and AT&T? So that is definitely something you need to consider if you decide to look closer into this company. Thank you so much for watching, guys. And if you did enjoy the video, please leave a like and consider subscribing to the channel if you haven't done so already. It really helps me out a lot. And I will hopefully be seeing you in the next videos. Bye.